This should be fun. So we're here to talk about money. Anyone here interested in money? Okay. I'm not promising that you're going to get any. We're just going to talk about it. So let's get through this. The organizers have put together a fabulous panel. We cover the waterfront from seed, angel, VC from a couple of different perspectives. I joked with them that we should have Goldman Sachs up here. They promised they'd think about that for next year to take the far end of the spectrum. So we'll see where that goes. We're going to divide up the panel and our presentation in this way. First, each panel member is going to tell you briefly what their organization is doing in terms of investments, what they're interested in just a very short commercial. We're then going to look at our conversation in sort of 3 or 4 buckets. The first bucket is advice to investors. The second bucket is dealing with VCs. The third bucket is a little bit of big issue discussion, what's happening in the world of investing and why, what do we expect going forward. And the final bucket is you. So we're going to try and do this in about 45 minutes. We're going to try and leave about 15 minutes for the audience to pose questions to the panel. You can do that. You can see the hashtag over yonder. It's on all your material. If you have a question, send it tweet it to the hashtag. The organizers will pick it up and we'll select from some of those things, and we'll try and do it that way. So that's the way we're going to do it. Okay, so let me start. My name is David Pamenter. I've done a bunch of things, and I'm a director of those angel organizations. But my preoccupation at the moment is that I'm an executive in residence at the University of Ontario Institute of Technology, Ontario's smallest university of which no one has ever heard. We are 10 years old, 10,000 students, STEM-based, situate in Oshawa. So my preoccupation is dealing with student and researcher-led companies. Ottawa and Carleton both have very similar programs in Ottawa. But it's an interesting challenge. So we talk about early investing. This is like really early investing. So that's my background. Neha, do you want to start?
Yeah, sure. I'll kick it off. Neha, Khera. I am a partner at 500 Startups Canada. For those that don't know, 500 Startups is a fund that is based out of Silicon Valley. We're raising a fund now in Canada, $50 million to invest in Canadian companies at the seed level. And kicked off in January of this year. We've already done 30 investments. So we're really active. And we're looking at companies in typically the ICT sector, great founders, strong product market fit. And yeah, we're having a great time.
There we go.
My name is Cubitt. I'm Managing Director at Mistral Venture Partners. My day job really is predicting the future. And we have a whole bunch of kind folks who've given us about $50 million to bet on the entrepreneurs that are building that future.
Jess.
Good afternoon. My name's Jess Joss, and I'm with York Angel Investors based in the GTA. I'm an angel as well as Executive Director of the organization. Our organization was formed in 2008. We've got 70+ accredited investors, done 80 deals, and about just under shy of 15 million in terms of what we've invested. We always look for great entrepreneurs. We're looking for post-concept, post-revenue, and looking to bring smart money to the table to help entrepreneurs grow and accelerate.
Thank you.
Tom Valis, Celtic House Venture Partners. Our roots are here in Ottawa. We were started in 1992 by Terry Matthews. We're on our 4th fund, and I believe we've generated about $2 or $3 billion in exit value. I think our passion is working very closely with founders, and for better or for worse, we love deep technology.
All right, thank you. So our first, our first session is on advice to entrepreneurs who are seeking funding. And the first topic I'd like to talk about, I jokingly refer to as buzz killers. So you all see endless applications for money on a regular basis. Rather than trying to tell people what needs to go in it, what are the killers in the application or the presentation that makes you decide to pass? And some possibilities are, the CEO doesn't look to be coachable, the company doesn't own its technology, it licenses it, is crowdfunding a problem? If a company's taken crowdfunding in the past, is that a problem today for future funding? Does the company has interesting things a la Bombardier, multiple voting shares, which are going to be a problem going forward, and lots of others. So why don't you start about code about, you know, what are buzz killers in a pitch or presentation as far as you're concerned?
I guess the way I'd approach it is that, you know, before we make an investment, we get to know the entrepreneur. It's not a 0 to 1 in 2 weeks kind of thing. Lately, candidly, my pet peeve lately is I get a pitch deck and they say, well, we're closing $3 million and you got 3 weeks. Are you interested? And this is just a non-starter. But even before that, I think that the buzzkill is when you meet an entrepreneur and you're really excited and you hit it off, and they share their presentation, they share their view of the world, and it's got a bunch of assumptions that are just too big. And then you meet them again 3 or 4 weeks later, or a month or 2 later, and they've missed almost everything that they've set out to do. And it's not like you shouldn't shoot ahead, but you need to sort of set expectations and over-deliver consistently. And it's not about, you know, pleasing someone until you get their check and then go figure out how to do it. It's about, you know, slow and steady and reasonable and honest approach.
Okay, thank you. Anybody else want a shot?
Yeah, so I think there's definitely a misconception when it comes to venture capital, and startups are now using it as a checkbox to define what success looks like for a young company, but you know, statistics show that I think 5, maybe 10% of all sort of ICT companies actually go on to raise VC, and it's actually not the norm, it's the exception to the rule. And I think the founder really has to be in the mindset that I want to build a big company and I want to scale it fast. And that's sort of what VCs are hungry and looking for. And I'll often meet companies where, you know, they're happy growing at a steady pace for whatever reason. It's not a fit. And so I encourage them not to go after VC money and say there's so many, I mean, revenue is the cheapest form of financing. If you can get to revenue fast and not have to take dilution, and you know, you're not comfortable giving up control of your company, and you know, encourage entrepreneurs to take a really, you know, introspective look at whether or not VC is right for them, and most times it's not.
You know, one comment I would make about working with venture capitalists, we work with a lot of repeat teams. These are people with plenty of money, or arguably more money than they know what to do with. Sometimes they, you know, in one case, the founder went on to do 2 startups after he exited with VC money, both of which failed. And he still wasn't short of money. And then he went back to work with the VC community simply because we provided structure and accountability. And he wanted to kind of work in a professional context in terms of hiring, in terms of option plans. In that case, his experience working kind of outside the VC community was simply not structured enough for his level of ambition. So there's, I think, many aspects other than money that play into working with VCs.
Okay, Jess, your favorite buzz killer?
I think for our organization, we really try and be very transparent and start the relationship even before they're ready to apply. So we're very open to having entrepreneurs come and attend an investment meeting, meet our angels, understand what they're looking for, and hear their feedback on other pitches. And then we work through a funnel process of applications and different levels of interaction before somebody actually presents to our group as a whole. In terms of things that sort of are buzzkills or sort of turn us off, we're really keen on lean startups, people that are looking to, you know, really reinvest in their company. They're not looking for a fancy car, they're not looking for great, you know, vacations. They're looking to reinvest and use the money to help them scale quickly. We work in a number of different industries, and we have a lot of angels that have a wheelhouse experience and great mentorship opportunities and networks. So we'd like to really bring that to the table. Coachability is huge for us. The reality of it is sometimes an angel or an entrepreneur comes in and it's like they think the angel who is investing their own after-tax dollars is more of like a government granting agency. But you really want to get to know the entrepreneur, and you want to know that your money is safe with them and that you're going to be able to work together and develop a relationship long-term. Touching on the crowdfunding aspect that you brought up, David, for us, we see it, if it's an early stage Kickstarter campaign or something like that, that's just market validation that there is an interest in the market. So that's not an issue for us, you know, at an early stage.
For the rest of you, crowdfunding,
I would see it as a distraction. I think that the sort of size of money you're going to get crowdfunding, certainly in Canada, is just too small to really make an impact, certainly for the kinds of projects that we would do. So again, it's not a universal message, but for the scale of projects we tend to do, I would see it as a distraction.
Okay, Code, what do you think?
You know, I mixed mind about crowdfunding, crowdsourcing. I think it's a sign of the times, right? So being an entrepreneur today versus 10, 15, 20 years ago, it's the cool thing to do. And it's, you know, in university they drive it hard, and lots more entrepreneurs are getting created on the entrepreneur side than there are capital sources. And so, you know, laws of supply and demand, you have a lot of entrepreneurs, but you have no cash, and so things like crowdfunding, you know, happen. The issue I have is it's a small stopgap at the early stage, but what comes at the next layer, right? And you can't go back to that can more than once, although there are exceptions. And so while it's validation and it's good as a Kickstarter, I don't think it's a funding strategy.
Yeah. Okay, Neha?
I think there's a time and place. I think it's interesting for hardware companies to sort of validate concept and get to prototype. So I don't have a negative sort of connotation against it from that aspect, but you know, it's a net neutral for me.
Yeah. Okay. I mean, I think the issue with crowdfunding is that you have to be able to manage your cap table, right? If you've got a really messy cap table with a zillion shareholders, all of whom are small and half of which you can't find, it's going to be a disaster when you go to raise more senior funding. There are structures, of course, that let you get the crowd within a box and deal with them as a group. But this a few shares to a few people at a few times, I think is probably an ill-advised strategy, just from my practicing law days. Let me put that part out there. Okay, fancy voting shares. And Jess, this is more for you and Neha, I think, than you folks, because you're more likely to see the share structure early in the day. So we've all seen deals where there are 3, 4, 5 classes of special shares. We've all seen, you know, wild and wonderful, rights and attributes attached to those special shares. Sometimes it's an attempt to protect the position of the early investor. And my personal view is that that's generally a mistake. I mean, I come from, the space of emotionally as an angel investor. I think you should be investing the same way the founder does, and to me, that's generally common shares. From a legal protection point of view, there are better ways to do it, but I'm not sure that special shares are the way to go. What do you guys think about? You're presented with a set of articles that has weird and wonderful shares, and a bunch of them are issued. What do you think?
I'm actually going to defer this comment because I'm not seeing that a lot. At my stage, we're seeing lots of safes and convertible notes being used. In fact, I think the safe is being extended too far, and people are raising $2, $3, $4 million rounds now on safes. So I'm going to defer the question over.
So I'll jump in. I think, if you have to revert to the articles to solve a dispute, you've already lost. True. And in most 99% of our deals, there's really kind of common shares and preferred shares, and it's really just separating employees from investors. And I can't think of a situation in many years where we actually had to revert back to the rule book to arbitrate something. I think at the early stage and startup stage, it's a function of trust between the investors and the management team and the employees, and you have to figure out how to work with them. And if you're not working well together, you probably have the wrong investors. I just think using the rule book is the last resort.
Yeah, Jess?
Our group, if we are the lead, we love to do pref shares with a 20% warrant that never expires for the entrepreneurs, and that allows, for great upside if there is an exit, and also sort of slows the conversation on what the valuation actually is, and it's got some angel protection in it as well. But again, we often come in, we're very early stage, we're often just after the friends and family round, so that it's a clean table when we're coming in. Often it's been very sort of loosey-goosey until it comes to us, and so we're quite happy to sort of work with a structure and lead it from there. And in terms of what Code said, I think that couldn't be any truer. When I talked about getting to know the entrepreneur before we actually invest, it comes down to trust and having a lead angel that is involved with the organization. We generally take a board seat if we're leading, and that's generally somebody who's got the wheelhouse experience that can bring added value to that angel and really or sorry, added value to that entrepreneur. And at that point in time, you've got such a deeply embedded investment, and you have common goals that you can generally work through it. It's a form of marriage, right? Yeah. So you have to work through things, and again, the paper is only the rule book is only as good as the paper it's written on, but it's really about the relationships and being able to have a common vision.
Tom, do you want to vote on this?
Yeah, I would say often you get into a dynamic where nobody wants to price. The founder has an expectation that somebody, in the future is going to pay a lot more for them. Our style is to set a price, not to try to kick the problem down the road. So, it may take 6 months of work. But I think it's so important to have a clean cap table, to actually have a value on the company, especially when you're hiring, you have employees, you're building your team. If no one really knows what the value of the company is, I think it makes it much harder to grow the business.
Yeah. Okay, we'll get to valuation again several times, but before we leave this section, can we talk for a bit about dilution? Entrepreneurs are always concerned, with good reason, about how much of the company they have to give up to get funding at various levels. And there's always the discussion about, is it better to own a big piece of a small pie or vice versa? I've got personal experience with one now where the founder, doing his private equity round, holds 10% or so of the equity. The rest has been diluted out through a series of rounds. And I must say, in that case, the private equity investor, after the founder bitched, found a way to give him more shares. Gave him a bunch of warrants, a bunch of options, gave him the ability to, sort of buy his share back up on special terms, which I've not seen before in a private equity deal, but I thought was just the right way to deal with it. So what's any rules of thumb about what people should give up? And I know it's relative to value and so on, but anyone want to, what advice do we have for the crowd about dilution?
So the rule of thumb we use is roughly 20% per round. If a company comes to us at the early stage and they've already given up 40% of the company, that actually is unfortunately a rule breaker. And we tend to walk away. There's a lot of incubator type programs out there where they bring companies in, they take 40%, they incubate them, they spin them out. Great companies coming out of that, but again, we're not even concerned about ourselves. It's the later stage funding. Our Valley colleagues, both at 500 and at other firms, it's rule breakers for them. So we're just afraid getting in on those companies, knowing that they'll have trouble with their downstream capital.
Yeah.
I think as an entrepreneur, you have to believe that the pie is going to be really big at the end of the day. And your slice of that pie is obviously diminishing over time, but you also have to believe that the capital that's coming in is absolutely creating growth in that pie. So from the pure practical perspective, assume you're going to give up 20 to 30% at every round, and so you start out with 100 and you give up 30%, and then 4 times later you're left with 40%, and then you divide that among the founders, right? So one problem I see is you get 2 or 3 founders and you're all excited together and say, okay, we're going to make it even split, everyone gets a third, and before the end of the day you got one founder who left and they have their third. They're no longer adding value, but they still own that big chunk of the company, and or you get into fights along the way, and so you get diluted further and further. If you don't accept the premise that you're going to get diluted down to 10, 20% of what you originally had, and that the pie gets bigger, you shouldn't take dilutive capital. You should fund it with revenue. You should fund it with other sources.
Okay.
Following on what Code says, we would generally say, take as little money as you can at our early stage, do as much as you can by lean and bootstrapping, so that you do have when you're diluting at the next round and the next round, that you still are left with, that decent sized piece of the pie for the bigger value overall.
Yeah, I would say the ratio you should always keep in mind is whatever percentage dilution you're taking, you have to believe that the market opportunity you're creating as a result of that dilution is at least 5 times that. And if you think that ratio doesn't hold, you shouldn't be doing it.
Yeah. Okay. Super. Thank you. But a question from the audience, I just want to throw out to the panel, and I'll rephrase it a bit. The question is, how important is it to have a co-founder? And I'd extend that to say, how important is it to have an assembled team when you go looking for money?
So I'll start out. We really like companies with 2 co-founders. And the number one reason is that it's really hard to be an entrepreneur, and to do it alone, it's that much harder. And so two co-founders, if they get along well and they have a history of working together, they can bounce ideas, they can prop each other up when times are bad, which by the way is 90% of the time, and they have somebody to party with in the other 10% when things are going well. So we like that a lot. And yeah, I'll leave it at that.
Yeah, you know, a sort of a dream team alignment, which we've had in some of the billion-dollar exits we've had, is kind of a forward line with a clear center. That's somebody who's typically a repeat entrepreneur, an excellent negotiator. Then you have kind of in left wing or whatever, you have a CTO who's you know, a consummate tech head, and then you have a consummate marketing person on the other side. And that's sort of one, you know, center forward who's your lead negotiator, and then you have, you know, a marketing SaaS head on one side and a deep tech person on the other side. That's sort of the dream team forward line to bet on.
Yeah. A well built out team mitigates the risk from an investor. If you've already got a strong team going forward, we look at it as you've got the people in place and there's a good chance that you actually are going to be able to execute on what you're promising. So it just mitigates risk from our point of view.
Yeah, of course. And just as a follow-on, from my own point of view, how common is it for you to help an applicant, presumably after you've invested, build a team? Is that something you see as something to which you can contribute?
How long?
You know, how often is it that you would do this? Is this something you see as part of your function? Is to help the founder find the right people to
Oh, for sure.
to work around them? Yeah. Okay. I just assume the answer to that's a yes. All right. Dealing with funders, dealing with investors. So, how about suggestions of fights you cannot win with your investor? Things you should not ask for. You should not go there. Don't waste your time.
You'll never win with investors.
Don't piss off the investor.
Don't even think about it. You'll always lose.
Yeah.
Okay.
Well,
we hold all the cards.
Yeah, that's the bottom line. First, let me start with the easy one. NDAs, just by show of hands, I assume no one will sign them. NDA. Non-disclosure agreements, no one will sign them. No. Don't ask. You won't get it. They'll just think you're joking. Okay.
That their idea is incredibly unique, but with the volume of pitches that we see on a regular basis, I mean, we see that pitch the next week.
No, I think we all understand why we're not going there. So aside from don't fight with us on anything, any specific things that you just regard as being beyond the pale in a negotiation?
And it's, maybe it's a bit of a diatribe, but I really get annoyed by the entrepreneur. So when you say no to a company, we say no way more than we say yes. Unfortunately, that's the case, and that's just part of the business. And we say no for 1,000 different reasons. And I'll be honest, some days you say no just because you didn't like the guy or the girl, or you're in a bad mood, or you just finished a deal, or you know you want to take the month off, whatever it is that's on your mind. And you do your very best to send a nice polite note that says, look, we're not interested right now. And sometimes, if you're feeling generous, you'll give a reason or two. One of my big pet peeves is someone who comes back objection handling. And the no is no, right? And it's no, not right now. It's no, it's not if you handle this one little sentence that I was kind enough to give you as advice, if you respond with an answer to that, it doesn't instantly turn to a yes. The answer is no. Come back in a month or two and give me an update. That's okay. But don't chisel away at it. It really irks.
Yeah, I think that's a key point that we don't understand, is that a relationship with a funder is a relationship. It does have to be built. It does have to be nurtured. It is often not a quick turnaround, and it may be a long process. And you may eventually win. Okay, any other don't go there's?
Yeah, I think this whole, just picking up on Code's comment, right? When you take the time and you try to give a positive no, at some level, you don't really have to do that, right? And if somebody kind of takes that and tries to twist it, it's really not in the spirit that it's intended, right? I mean, we're all trying to build a strong community here. So, even if we're not necessarily going to invest in your company, we still want to see you succeed. We want to see Ottawa succeed. we're not really competing with each other. We all have a vested interest in a very strong tech community, right? I certainly saw it here in the 90s in the networking industry. We all want to see some vibrancy. So don't try to take those comments and do that whole objection handling thing.
And if you don't agree with the comments, name calling, really not a great sign to build a future relationship. We've had one or two scenarios where you name calling and then you think that there might be an opportunity. I don't know, name calling doesn't fall in the coachability and good relationship category.
Probably not. So you see lots. What do you think?
Yeah, so I've had the experience in the past where entrepreneurs will try to create this FOMO, fear of missing out, and they'll name drop, oh, this fund's interested, this fund's interested. Dirty little secret, unfortunately the venture capital industry in Canada is so small. I mean, we're all so connected, it takes one phone call, and it just, if you lose that trust in the entrepreneur because they've sort of embellished about something, for me that's just like I'm just walking away. So just be careful with that name dropping and just be honest and upfront.
Okay, thank you. Now, let's turn this around a bit. So what advice do you people have to founders looking for money when choosing a VC? I tell my people they should diligence their VC. Because there are VCs that are better in some areas than others. There's some that have expertise and not. And there's chemistry often in dealing with your VC. So I think that's obvious, although lots of people don't do it. So what else would you tell them about choosing a VC?
So I can start. I would say do your research and make a list. And once you've got your short list, find an introduction to those VCs. And once you've gotten the introduction, build a relationship. I love it when entrepreneurs come in and they tell me a story as opposed to ramble through a 10-page slide deck. Just build a relationship, and because at the end of the day, that's what sort of that dynamic is all about.
I'll echo Neha. I think she nailed it, right? So be very thoughtful about who you approach and how you approach them, right? A cold email's not going to work. Something over the transom's not going to work. An intro from someone that we would trust is going to get you that first meeting. And then, don't oversell it. Make sure that you set expectations and then follow up a month later and say, yeah, this is what I told you, this is what we did. And do you mind if I keep you on my tickler list? And then month after month, we're seeing the progress, and then you check in, and eventually we pull the trigger.
I think it's allowing yourself to build the time, because all of us are talking that the relationship is fundamental. So don't allow yourself a short runway of 3 weeks or 4 weeks and expect something to happen. Like, start talking and start building the relationship way before you're ready to go down that path, so that you're already a known quantity, so that we've already seen the progress, and then it will move more quickly at that point, but we've also built up the trust at that point.
I think doing your research on the VC is critical, right? If you're expecting the partner to spend an hour with you, you should be prepared to spend 10 hours understanding that VC, understanding their portfolio, understanding what their most recent investment is, understanding where they're heading, who their network is. Again, don't expect engagement unless you're willing to put in a multiple of the work that you're expecting from them. Because again, that's assuming we come in, we're expecting you to work 10 times harder than we are.
When do I need you? Can we start off with that? Because I feel a little bit accosted that, hey, don't come unless. I would love to know what makes me need you.
Yeah, I think that's a great question.
Fair enough on that one. So we're really early stage. We're just post-concept, post-revenue. I would love to see entrepreneurs come before they're even ready to look for investment, to start building the connections and look for the mentorship. And when you're coming is when you're looking for money to scale, but you're also looking for a partner who has wheelhouse expertise that's going to help you grow. So certainly, I don't like to see it as adversarial. In our little bubble, we try and be very transparent and have entrepreneurs coming long before they're ready to apply for us, so that they're starting to make the connections, so they're starting to get the suggestions, and so that there's a dialogue starting and the relationship and trust is being built earlier. So we'd rather not see it as adversarial, because that's not, you want it to be win-win, and people want to work together in a good quality relationship. So come when you're starting to, before you're ready for the money, but starting to look for the advice and the connections.
So if I can add to that, I'll take something from both of my colleagues here. Neha said very clearly at the beginning, venture capital is not for everyone, and that couldn't be more true. There are lots and lots and lots of businesses that should never take venture capital. It's expensive, it's difficult to manage, but it's high octane fuel for the right business. So you kind of have to ask yourself, am I in the right kind of business that can use this type of capital? Because you have to remember, for every dollar we put in, we want 100 back. Like, that's how we think. And so if you're not of that profile in a rapidly expanding new market with really disruptive technology, you should find another way. But maybe more to the point, you come to us when things are breaking that have that our cash can solve and produce a 5x, to Tom's point. If my dollar produces 5 times more value inside your business in terms of customer capture, IP development, et cetera, then it's good lubricant. Otherwise, you might as well just catch your debt. If you're going to grow at 10% a year, it's not venture capital. So again, just to summarize it, I think it's when key things are breaking that are fundamentally holding back your business from growing 5x from that point.
Yep. Okay. Thank you for that. I'm surprised that no one in the panel mentioned look for a VC who has deep pockets, the ability to syndicate, the ability to help you get into the United States. Why is that not important to people who meet Code's criteria? I mean, to me, that's kind of key, because you don't want to get stuck.
So let me pile back in again. Sorry for being so verbose. So here's some stats for you. It turns out that less than 10% of Canadian startups get capital from outside of Canada. But of all the exits Canada-wide, 33% of them come from that 10% pool. And furthermore, 40% of the profit comes from that 10% pool. So to your point, David, it's absolutely critical that you find deep pockets to make sure that you can get all the way. I've never seen a company go out of business for lack of funding, right? If you run out of money, you run out of time. So as a firm, and you know, this is our strategy, our core strategy. We invest at the seed stage, we introduce all of our companies to US investors when the time is right, and we make sure that the follow-on funding is from guys who can write a $10 or $20 million check and make sure that you can see the promised land. So I think the point is you have to think globally, you have to be born global, and getting investors from outside of Canada has to be core to your strategy if you really want to win.
Yep, thank you. Anyone else?
Yeah, I think at the early stage level, we're not fussed whether or not there's a US VC on the cap table, because to Code's point, we can facilitate those introductions. Yep. But it's more so the mentality that, you know, I'm ready to go south, maybe not move my company down there. In fact, we don't want to see that. But when the timing is right, you know, I'm going to go down and I'm going to, you know, meet as many investors as I can. And I'm not just thinking Canadian, I'm thinking US and globally. So it's more a mindset thing more than anything. But in terms of getting those VCs on the cap table, you know, that's where we're there to facilitate the intros.
Oh, okay.
Yeah, I would say you're going to try to get the best VC you possibly can, and you should do a lot of research on you know, what deals people are doing, you know, what sector they're active in, talk to their portfolio companies. The more work you do in understanding us, what our objectives are, the better your engagement will be.
Okay.
And I would say at our stage, I mean, again, we're very early, but I think a lot of our angels expect that we're going to go into another small round before you are doing your Series A and so on, because we want to be with you to grow and to bet on it long term. And we'll, you know, go in another round and we will get diluted, but then you will see, you know, the lift off as you go to the VC level and beyond global.
Yeah, actually, that's a great segue. Thank you. We hadn't planned this, but in any event, angels tend to be the earliest investors after your mother. Angels have a limited capacity. They're writing bigger checks, doing more and more syndications to get to bigger numbers. I should know the stat, but I don't. The average deal is $500,000 or something in angel funding last year, and much bigger this year. And those are because angels are clubbing together rather than having 1 or 2 angels write checks. But angels fatigue relatively quickly. They have a limited ability to write checks. They have a limited ability to manage the stuff in which they've invested. So eventually they stop. The question then is, can we get our companies far enough up the development scale so that they're appealing to seed investors, if I can choose that characterization? And given what we've seen in politics and federal politics in recent days, I mean, it looks as if the feds are focusing more on, the acceleration to exit end of the spectrum, the more mature companies, and paying less attention to the early stage ones. So does anyone think it is the case that early stage seed money is more at risk now, i.e. there's less of it than there was before? And if so, how big a threat is that to the ecosystem? Because those are the companies we have to feed into the funnel for the later stage investors. And I know you have a view on this one.
Yeah, so I think it is at risk. I love the focus on scaling companies right now in Canada because that's a huge gap, and the more money we can pour into there is great. But I'm also a massive proponent of we have to keep the funnel filled. And I think that there's a lot more risk we can be taking in Canada with respect to funding companies coast to coast. You'll hear the comments that there's enough seed funding in Canada. I disagree. I mean, we've done 30 deals in 5 months. We can't write checks fast enough because there's a lot of great possibilities. I'm sure 80% of these companies may fizzle out, but the fact of the matter is that they're great innovations that deserve a chance. And this is the mentality that the Valley has, and this is why the Valley has where it is a little bit easier to raise money because they're more risk-taking. In Canada, we're a bit more conservative. So we need to keep our funnel filled. We need to keep the seed dollars flowing. We also need to make sure that the rest of the funnel fills out nicely with late-stage funding and beyond. But we can't take our eyes off of that top of the funnel. It's definitely a big concern, and the angels will fatigue. I'd love to hear Jess's comments on what she's seeing.
Over the last couple of years, what I've seen as changing in terms of how our angels invest is it used to be they'd write bigger checks, but the reality is we're not seeing the exits as fast. So we're writing more smaller checks and putting our eggs in multiple baskets. But I think there's also a level of understanding that we're probably going to write a second round and that we're also going to facilitate introductions and so on. In terms of keeping the funnel full, I mean, angels get you through the valley of death, that moment where, the revenue you need to scale up very quickly, and we will get you through the valley of death. We'll help you get to the next level. I think one of the things that we found is that if there's a level, I guess it's the philosophy behind angels. Yes, it is also, it is to get a return on our investment. So please never come with a pitch that doesn't actually show how there's going to be an exit or a return on our investment. It's not a full charitable function. But most, at least in my demographic, most of our angels are exited entrepreneurs who remember that one person that made the difference in terms of a piece of advice or bridging, a little loan that bridged, payroll or different things like that. So there is an element of philanthropy there, not because we don't want our return on investment, but because most of us have been in the situation where we remember that person that makes a difference. So as a very early stage, I think perhaps we do have some heartstrings involved as opposed to pure metrics, and again, that comes back to the relationship. So you will potentially get a second round that helps you then get further along until you're ready for the seed.
Yeah, I think it's absolutely critical to have a very active seed and Series A community. Once you're at Series C, you can attract North American capital. Like if you're at $1 million MRR, it's a fungible, it's almost a commodity, right? You could have 20 term sheets tomorrow, right? And so adding a 21st Canadian private equity firm doesn't really move the needle, right? But if you're at 100K MRR and you have some great, AI technology, fine. But the problem is there are 10 other companies similar to you in the Valley, and all the Valley investors are going to do them rather than you. So I think the sort of importance of an indigenous VC industry is absolutely at the early stage, because as the stage goes from B to C to D, it becomes essentially financial engineering, right? And the role of kind of a local VC becomes less relevant. So I actually think we don't need more later stage capital, because you can access there's a big fund. SoftBank has I think a $500 billion venture fund. Well, if you're at $1 million MRR, you can access them. If you're at 100K MRR, you can't. And that's the role of local venture.
Okay. Right? Good. Okay. So let's talk about valuation. Valuation is always fun. We run a university incubator. Lots of people are involved in accelerators and incubators here, there, and elsewhere. And they're all over the map in terms of their size and who they accept and who they don't. at the very early stage level where I'm involved, I don't think there's a company that comes out of our incubator that doesn't think it's worth $2 million, which is probably, I mean, come on, guys, let's get a grip on reality. And then, of course, they have to go and talk to these people saying, I'm worth $2 million. Probably not really well received in the circumstances. So how do we manage that? Are accelerators and incubators doing their clients a disservice by filling their heads with nonsense? And when we've done that and sent them to you, I mean, how do you get them back to reality?
Yeah, it's a tough one. I mean, Y Combinator in the U.S. I think has a standard 10 million U.S. valuation every company that graduates, and it's like, oh my gosh, but they're Y Combinator. That's the bar that they've set, right? What are you going to do about it? Valuations are tricky, but you know, at our level where we're coming in, I'm not seeing much less than 2.5, 3, but it's flying all the way up to about 10. And if we see something, if we see a round that's been valued by a respected third-party or institutional investor, angel group, I'm fine with it. But if it's the entrepreneur trying to price themselves, that's where I'll push back if I don't think it's a fair number.
Yeah, and you use a variation on a safe, right? For
Yes,
most of your
we use
deals?
a variation on a safe. It's called a KISS. Keep it simple. Security. Keep it simple. Security.
Valuation issues?
You know, valuation is driven largely by the market, and it goes up and it goes down, and it's a function of supply and demand fundamentally. I think the way we approach it, actually I was talking to David, Tom's partner earlier, we approach it with a simple spreadsheet that we share with the founding team, and we say, look, here's your ownership today, and here's how we're modeling your business. If you meet these milestones, we think you're going to get to this valuation, which is driven ultimately by public markets, right? So there's comps you can drill back down from. And we say, okay, here's our economics. Here's what we're going to invest today, and here's what we need to see on the other end to be a profitable business ourselves. And so that collaboration, you know, hopefully you find a middle ground that fits uncomfortably for both, or just uncomfortably enough. But rather than come in and say, no, you're worth 2 and we're taking 50% of your business, we have a more sort of back and forth, figure it out approach.
Certainly, we always like to have discussions. There's a couple of different, sort of theories or formulas you can use in order to work with the entrepreneur to come up with a valuation. As an angel, if we hear 10 million and you're pre-revenue, the conversation, maybe that is sort of the deal breaker for us, just pre-revenue and 10 million. So there has to be something to back up the numbers that you're speaking for. So as you say, David, if it's an entrepreneur sort of valuing themselves, it's kind of like going to your mother and she goes, yeah, you're absolutely great, fantastic, but you may, as Neha says, want a little bit more of a critical eye to where you're going to be, and then grow and develop from there.
Okay, Tom?
Yeah, it's just another business negotiation, right? As part of your skill as a CEO founder, you're trying to get the highest valuation, right? Go for it.
Yes.
See what you can get. There are founders who, with a straight face, do $20 million pre's on absolutely nothing, and all the power to them, right? If they can create a reality distortion field to get money in, that's great. But again, it's all about your skill as a CEO, really.
Yeah. So a question from the audience is, how do you value pre-revenue startups? So we all know in that stage you can think about so many dollars attributed if there's a good team, so many dollars attributed to the technology or the business model, so many dollars attributed to whatever market traction they may have, and that rolls up to a number. Any advice as to how a pre-revenue startup should approach a lender, saying, I am worth this and this is why? Jess is going to take this one on. Okay, go.
No, I was actually passing it to Neha. But what I would say is, I think coming in and thinking of it as a negotiation is probably the best way. You may have your ultimate idea in mind, but work with the angel, in our case, look at the financials, and let's come up with what's actually realistic based on what you're bringing in and where you're going from there. So don't have a firm number, and it's not yay or nay, it's starting a discussion and building the relationship.
Yeah. Okay.
And create a competition, right? So the deals we've paid up the most in were experienced founders who knew what they were doing and could clearly articulate their business and had 3 other term sheets. And we had to compete. that's the best way to get the best valuation.
Absolutely. Create a feeding frenzy, right, for yourself.
What's that word? FOMO?
All right, let me remind you, questions, please, you can send them to us at that address. But carrying on.
Just could I make one comment
Yeah, of
about
course.
valuation? All joking aside, be careful what you wish for, because you may be able to negotiate a high valuation, but the higher the valuation you're going to set for yourself, the higher the expectations. So you're also eating into your margin for error. So the lower the valuation you've given yourself, because things inevitably are not going to play out the way you think you can. And if you max out your valuation, you make one single mistake, you got some pretty unhappy investors. Yeah. And so you have to decide where you are, but by accepting a lower valuation, you're giving yourself greater margin for error, or the ability to pivot and have your investors behind you. So, I think that's a very, very important thing to keep in mind.
Yeah. I had one relaxed VC say to me recently, if I'm looking at a potential investment and I got a $5 million valuation on it, and I think I'm going to get to, whatever the multiple is that I need to be successful in this, fooling around about $1 million on the valuation level is just not worth anybody's time. I'll just give the entrepreneur the $1 million and we'll move on, because I want the deal and I'm going to make a whole lot more than $1 million, or else I'm not doing the deal in the first place. So that was a refreshing approach, I thought, to the issue. Availability of VC capital. So we're talking relatively senior investors at this point. There's discussion in the community that the window may be narrowing, if not closing. There's less money available in the VC community, fewer deals getting done. Is this a sign of the times, or is this just paranoia?
I don't think that's true at all. In fact, last year was a banner year for Canada, and this year's off to a hot start as well. Just sort of at a macro level, you have programs like VCAP, the Venture Capital Action Plan that was put out by the Fed, the last government, and there's a new similar program being entertained by this government. It was in the budget announcement, which will create another $1.2 billion of venture capital money that goes into the system. And also, over the last 5 years, there's been more distributions from venture funds, sort of North America-wide, than there has been funds created. So there's certainly a flush of capital. I don't think there's a dearth at all. However, and this is the interesting statistic in my mind, Canada, relative to the US, is typically about 10%, right? We think about GDP, we think about population. Venture is actually between 4 and 5%. So on a per capita basis, we spend half of what the Americans do, but we fund the same amount of companies, the same number of companies relative, right? So last year in the US, about 4,500 companies. In Canada, there was 500, so call it 9–10%, but half the number of dollars. So that means A, you all are a lot more frugal and efficient with your dollars, but B, it means that there's a long way to go, that there's much more money that can be put into the smart brains in Canada. I don't think that's going to end anytime soon. We're on an 8-year up in terms of the markets. People are flush with cash. Times are good. I don't see a problem at all.
Okay.
Yeah, and I think I think Canada has really made a mark on the global sort of map, in the sense that the U.S. Investors are flying up here more often than ever. So many new funds are moving into town. Techstars is coming up. We just made an office here. And I think it's because the talent and the quality of companies here is right on par with what's happening in the Valley. And because there's less competition, the investors love coming here, because they have, they can work with the top companies, top talent, especially in the AI sectors. So, for anyone here building a company, you're doing great, and everyone's recognizing it on a global scale. And I think we should really be proud of that in Canada. So I think the gap is, I think it's not closing the window. I think it's actually opening. And I think we're going to see Canada just flying really high over the next 5 years.
Yeah. Okay.
I don't think you can look at the kind of tech market independent of venture. So I think actually venture creates the tech market. So if you scaled the venture industry by a factor of 10, you would scale the tech market by a factor of 10. So I don't think Canada is anywhere near saturation. And again, I think the supply of capital creates the preconditions for people who want to go to venture. For example, almost 80% of all new grads from engineering and mathematics in Waterloo go straight to Silicon Valley and contribute nothing to the Canadian economy. That tells me that the venture industry needs to be scaled by a factor of 10 in Canada.
Yeah. What do you think about, well, that's a little bit of self-praise. What do you think about companies coming out of Ottawa versus other tech centers in Canada? How are we stacking up?
It's going to be a rough crowd after we answer this question. Uh-oh. Look, I think per capita, Ottawa is batting, mixing metaphors here. We're way above our weight class. You look at the number of IPOs in Ottawa relative to the rest of Canada, and it's ahead. You look at the exit value creation in Ottawa relative to other cities, it's way ahead. And in fact, I was in Toronto recently, and it was a few months ago, the mayor of Toronto took credit for Shopify. I'm like, you know, so we've got a lot of stuff going for us here in this little town of 1 million people. I think there should be no excuses.
I think the key strengths of Ottawa is you can assemble complete teams here, and that's harder to do in a place like Toronto because there's so much competition for people. I think the loyalty, the work ethic, the community is extremely strong here compared to Toronto, where tech I think gets somewhat lost in the noise with the finance industry.
I think because of Ottawa's history in the tech ecosystem, there's a lot of people in this city that know how to build a big business. And that's why you're seeing per capita so much more success here than anywhere else in Canada, because there's those people that have been there, have done that, and that's a really big problem Canada has a whole. You know, companies are getting to a certain size, but then those individuals that know how to take that company from 10 million to $1 billion, those are far and few. So, but Ottawa's got that talent.
Okay, cool. Thank you. All right. Questions from the audience. We're pleased to try and answer anything you want to throw at us. I said we, meaning those people. And the man, do we have cubes that we can toss around?
Hey there. So I know a couple of the guys on the panel there, so a couple things. One is I heard a stat about we seem to fund about the same proportion of companies per capita, but with half the dollars. I read somewhere a couple years ago, I can't remember the stat, but the VC returns in the US were multiples of that in Canada. So I can't help but wonder if those two facts may be correlated, jab, jab. But what I really want to say is I've actually negotiated with a couple of you, and I remember, you know, I've done a few rounds for a few different companies over the last 15 years. And Code and Tom alluded to a spreadsheet or a model you use probably in your back office to help figure out valuation and model it forward. I know as a guy who's raised rounds, it's always this tug of war on valuation, and I would encourage you, if it's not proprietary, to share those models. Because in the last round I raised, you know, there was this tug of war, and what the tool that was able to get us there and bridge that gap was actually a conversation that was pretty akin to looking at the same spreadsheet. And so rather than it's like, well, I think it's this and we think it's that, actually sitting down with the spreadsheet, it was very quick to then be like, oh, okay, I totally get where you're coming from now, let's just get this done. And so if it's not proprietary, if you could share some of that stuff with the community, I think it would bridge the gap a lot.
Sure, I can comment on that, where the question is really about valuation and spreadsheets. I think you almost don't need a spreadsheet. Once you're in the sort of metrics phase, there are pretty industry standard multiples of MRR, churn, there's customer diversity. There's about 5 high-level metrics that drive valuation.
I think that's accurate, but I'll touch on your first comment, and you couldn't be more right, actually. So the venture returns in Canada, I'll take Celtic out of this because I think they're probably a poster child of success, were absolute shit for 20 years. I mean, they really were, and I wasn't here, by the way, so I was in the US. But I think there's a whole bunch of causal reasons or excuses, whatever you want to call them, but I think that's changing. You look at the VCAP program I alluded to earlier. Funds, there's a number of funds who've already returned capital from 3-year-old funds, and so partly the tide is rising and all the funds are doing better. But I think Canada, version 2.0 entrepreneur is significantly better than Canada version 1.0 back in 1995 when we were trying to emulate Americans. Canadians are leading now. They're being leaders, not followers. And so I'm hopeful, candidly, and I hope all of you make this happen, I hope that this version really kickstarts the entrepreneurial innovation ecosystem in Canada. And we make money, our investors make money, and you make money.
I can elaborate on some of the stats that you were blanking on. I think the top funds in Canada are at 20% IRR, and in the US it's 75%. So you're right, we have a long way to go.
Okay, thank you. Yep.
So one thing you guys mentioned consistently is obviously you need a great team to that you want to write a check for. And then I think a few of you did mention that it's great to have that kind of serial entrepreneur or someone who has had successful exits and things. But at one point, those founders must have raised some money their first time. So do you have any advice around funding the team where this is really their first raise or their first investment that they're going after?
Sure. The problem is sort of a chicken and egg problem, right? If you haven't been successful, how do you present a track record? One thing I always encourage, new teams who have never raised money is, get somebody on your board who's done a startup. There's plenty of people in Ottawa that have, exits behind them. They've probably made enough money. They don't need a job, but if you can excite them as a team, get them on board as an advisor, deal them in for some equity, and then have them work with you when you work with the VCs. So draw people into your orbit, and that makes your case that much stronger.
And I think another thing would be is to start the relationship early, like we've all been saying, but also under-promise and over-deliver. So if we've started seeing a relationship with you become familiar, you've hit all of your benchmarks and exceeded them, plus you have some good advisors, that's showing that there's going to be a good track record moving forward. So I think that's a way for a very early stage company who hasn't had, entrepreneurs aren't previously exited, to start showing that they have the commitment and the track record.
I think the point is that it is a community. You can reach out to people who have done this before. And other things being equal, they're generally pretty generous with their advice and assistance. So do it, put yourself out there. Sorry, I'm told by the organizers that the hook is out. So that's our panel for today. We hope you enjoyed it and learned something. Thank you for your attention.